Hello, and welcome back to Explain the Charts. It is March 24th, 2026, and today we are tackling one of the most volatile assets on the planet, gold, also known as XAUUSD. The market is currently reeling from a series of high-impact events, most notably the escalating conflict between the US and Iran, which has fundamentally reshaped investor sentiment. While geopolitical tensions usually drive safe haven buying into gold, we have recently seen a contradictory move where investors rotated capital into U.S. bonds as 10-year yields approach 4.4%. The Federal Reserve's recent decision to hold rates in the 3.5 to 3.75 range has further strengthened the U.S. dollar, creating a massive headwind for the precious metal. Despite this, many analysts are pointing out that gold recently entered extreme oversold territory on the daily RSI, suggesting the recent sell-off might have been overextended. Reports from today indicate that gold has begun to stabilize near the 4,400 mark after a period of intense liquidations and outflows from major gold ETFs. Let's jump into the daily chart to see how this macro environment translates into the price action we've seen over the last year. Looking at the daily time frame, the scale of the recent movement is truly historic, reminding us of the extreme volatility seen back in the early 80s. After a relentless climb through 2025, where gold hit record highs near $5,597 in late January, the market entered a sharp corrective phase. You can see a clear trend reversal starting in February 2026, where the price began carving out lower highs as the market priced out further Fed rate cuts. The most dramatic drop occurred in late January and February, followed by a period of consolidation that ultimately failed to hold the $5,000 psychological level. Just yesterday, on March 23rd, we saw a massive sweep of liquidity where the price plummeted to a low of $4,097 before an incredible $300 recovery. This 4,100 area has now established itself as the most critical pivotal support point on the entire daily chart. A daily close below that 4,100 level would likely signal a deeper bear market toward the $3,000 range mentioned by some analysts. However, the long wick at the bottom of the March 23rd candle indicates strong buying interest and potential exhaustion from the bears. Switching to the 1-hour chart, we can see the roller coaster ride that Robo4X and other analysts described today. Notice the sharp vertical drop during the early Asian session on March 23rd, where multiple support levels were breached in rapid succession. This move appears to have been a classic stop run, flushing out weak longs before the aggressive reversal took place later in the day. The recovery from 4,100 back toward 4,440 was equally swift, driven by renewed safe haven fears as news of infrastructure risks in the Middle East hit the wires. Currently, we are seeing gold consolidate around the 4,440 to 4,500 zone, which was a previous support level that may now act as resistance. The hourly candles show a series of higher lows since the 4,100 bottom, which is a bullish sign for short-term traders looking for a relief rally. However, we must be cautious as the volume during the recovery has been inconsistent compared to the high-volume sell-off. If the price fails to sustain a move above 4,512, which was a previous high, we could see a retest of the lower support zones. Dropping down to the 15-minute chart for an even closer look, we can analyze the intraday dynamics of this recovery. The price action on the 24th shows a more controlled, trending environment compared to the chaos of the previous day. We can identify minor support forming around the 4,450 level, where buyers have stepped in during small pullbacks today. The market seems to be waiting for the next major catalyst, possibly more commentary from Fed Chair Jerome Powell or updates on the Iran-US conflict. For scalpers, the range between 4,440 and 4,510 is the current battleground to watch for breakout opportunities. A breakout above 4,510 on high volume could lead to a quick test of the 4,650 resistance mentioned in technical forecasts. Conversely, a breakback below 4,300 would likely confirm that the bearish trend is resuming and the 4,100 low is back in play. Returning to the daily chart to summarize our findings, We have several key price levels that will define the next few weeks of trading. On the downside, 4,300 is the immediate critical support, followed by the major pivot at 4,100. On the upside, gold faces immediate resistance at 4,512, then 4,650, with a major dynamic cap at the 100-day moving average near 4,610. For the bulls to truly take back control, we would need to see a decisive break above 4,820 to clear the path back toward the $5,000 mark. My unbiased prediction is that we will likely see a period of range-bound consolidation between 4,300 and 4,600 as the market digests the current geopolitical news. I estimate a 60% probability of a sideways market in the short term, contingent on no further major escalations in the Middle East. If the Iran war intensifies or oil prices spike further, the safe haven bid could easily push gold past 4,700 regardless of bond yields. However, if the Fed hints at an actual rate hike rather than just a hold, the bearish pressure could force a retest of the 4,100 lows with a 30% likelihood. Always remember to watch the US dollar index, or DXY, as its inverse correlation with gold remains very strong in this environment. Keep an eye on the upcoming PCE and CPI reports, as these will be the primary drivers for the Fed's next moves and, by extension, gold's direction. Please note that this analysis is for educational purposes only and does not constitute financial advice. Trading precious metals involves significant risk, so always do your own research and manage your risk appropriately before making any investment decisions. Thank you for watching Explain the Charts, and we will see you in the next analysis.